Who Wants to Be a Millionaire was one of my favorite TV shows, a multiple choice question game show that made people millionaires. It was the kind of thing that you can only really dream of. You had to be either super highly successful in some sort of specialized field, or you had to be a celebrity. It was just something that the normal common person like myself could never imagine becoming. In this video, we're going to talk about how I will become a millionaire and how you can also become a millionaire. What is the crack, everyone? Welcome back to Buy Old Sell. I hope, of course, you are all well. Today's video, we're going to look at how to become a millionaire by the age of 50. Now, there will be a few things that I'll have to go through first, just so you understand the thought process here. And without further ado, we'll just get straight into it. Okay, so I'm all set. I've done my sums, calculator, pen, notebook. I'm good to go. I am a quantity surveyor, so I'm pretty used to doing math on the regular basis, and I do enjoy it. But there is great websites out there that can take away all the boring stuff. You don't have to be a mathematician to work this out. I recommend going on to calculator.net, which we'll get into later. That will work out a lot of these sums. But just to start off, we're going to talk about the power of compound interest. In simple terms, compound interest is getting interest on interest. And that's where you want to be. That's the only way you're ever able to be financially free and to be in control of your own situation. Don't invest in banks. Banks are dead. They're dead money. It's a waste of time. And eventually, in my opinion, one day you will see the end of the general banking system as we know it. I did have an ISA account for my daughter, which was giving me 3% when I originally opened it a couple of years ago. However, it has since dropped to 1%, and that is a kid's cash ISA for the long-term future. I've no longer invested in that. Generally speaking, you're getting at best about 0.5% back on your interest. But let's be conservative. Let's just say times are good. Hyperinflation, inflation, recessions, all to the side. On average, you're probably getting in and around 1% interest in the bank. We go to REUTERS, we can see here, the Bank of England flags risk of recession and 10% inflation. You're getting 1% interest in your bank. So that means for every £1,000 you've put into your bank getting 1% interest, you're effectively losing 9% due to inflation. Does that sound like a good deal? But what about those people that decide, I'll put the money under the mattress, don't trust banks? Well, you might be on the right side of things to not trust banks, because don't forget in 08, a lot of banks went bust, which meant that banks just went, we don't have your money no more. Tough. So if you've avoided that by putting your money under the mattress, well, your £1,000 is now worth £900. So you've got to think about that. But again, be conservative. General inflation on a yearly basis is in and around 2 to 3%. So we'll split the difference. We'll say it's about 2.5%. Still, your 1% interest that you're getting in the bank still doesn't look at your 2.5% inflation. So what does that mean? You have a deficit of about 1.5% that your money is currently losing every single year. The deficit of 1.5 over 30 years will mean that your £1,000 is worth £365 less. So feel free to continue your investments in banks if you wish to lose money. But I would assume if you're watching this type of video, you're generally interested in investments, or you're already in the investment game. So in either scenario, you're probably keen to leave the banks alone. So smash the like button if you've found that informative and that has helped you make your decision. So what do most people save? Well, if we go on the Virgin Money, we can see here, some people will advise a percentage of your income, perhaps 10 or 20%. And that is what I would always go with. I'll split the difference. We'll say 15%. Always have money to save for a rainy day, in case your boiler packs in, perhaps inflation shoots oil prices up. Anything that can come out of nowhere that you have no control of, you should always have money, cash ready to go, because putting money on credit cards is not the way to go. So here are the assumptions I've made. 2.5% roughly average inflation. I think again, that is probably on the lower side, but we'll use that for this purposes. I also think that you're going to be able to save 15%, again between 10 and 20, so we're going in the middle, 15% savings of your annual wage. And the annual wage I'm going to go with is roughly £20,000, and you can adjust that figure to suit whatever currency or whatever you're in based on your national average. £20,000 divided by 12 is roughly 1,667. So we'll say roughly £1,500 considering tax and stuff like that. So £1,500 is what you'll be getting in your hand every month. And if you take away 15%, because you're saving that 15%, brings you to a lovely figure of around £225 per calendar month, which is roughly about £56 a week and in and around £8 a day. Nothing more than what you wouldn't get 2 coffees for £8 a day. So going back to the interest calculator, this is what I want to show you. So our target here is 1 million. I've plugged that in. Say £1,000 just to start us off with. 32 years. And the reason I've went by 32 years is because we're looking to do this by 50. And I'm assuming at the start of this journey, you're going to be 18. So 18 plus 32 is 50. And every month you're going to be putting in your £225, which means you need an average of roughly 12.41% returns. So now you'll ask the question, well, if my bank's only giving me 1%, where are you going to get over 12%? Well, let's have a look at the average stock market returns for the Dow Jones, the S&P 500 and the NASDAQ. Now, the S&P 500 is the top 500 companies in America. You're exposed to every single type of sector. The average return is generally 10% on the S&P. The NASDAQ is a bit more tech focused, it's a bit more for the future. So those types of stocks generally get you a better return because they're the growth sector. Again, on average, roughly about 14.39. And in my opinion, those trackers are relatively safe. But the NASDAQ is going to get you 14.39%, which is over and above the percentage that we need to make you a millionaire. So if you think you can put away £225 a month, £8 a day, you could easily become a millionaire by the time you are 50. But on this channel, we talk about stocks that will give you far better returns than 12%. On average, I would say about 20 to 25% returns, so you'll be able to do it a lot more quicker. And yes, there is risk. You must do your own due diligence, of course. At any given time, you could be buying this stock, and when you go to take it out, say you're on the 30th year, on the 1st of September, that was your day to take it out. The market could crash that day and you could potentially be massively down on your return. But generally speaking, over the long term, and investments should be over the long term. If you bought here and you wrote it up to here, this would be over a 20-year period, you're up 205%, so you're doing okay. And my course offers people to be able to learn how to buy and sell to any need that you want. You can do it on a weekly basis, daily basis, whatever suits. For the purposes of this, I'm assuming again, you don't want to do too much. You just want to put your money and kind of let it go. All it will require you on a weekly basis is to look at one indicator. And I'm going to show you this one indicator for the RSI, which is the relative strength indicator. All you need to know is that when this area here, and we'll bring it up, when you get into this area, that means it is oversold. When it's oversold, it's a good buying time. When it gets to this area here, that means it's overbought, which means there's too many people buying it. You should try to get out or take profits. So if I go back to our chart, the areas that I would be buying this stock would be here. I would be buying it here. I would be buying bits here, bits here. For example, when you're going to buy, say at the end of the month and it was up to here, I would be waiting 12th of November, I would be waiting until maybe sort of closer to December and let that go down. You don't want to be buying any more than around average or the lows. If you were to make those trades, I would say dramatically you'll see your gains go up and you will see that timeline come down. Let's say you're a bit more on in later life and you want to get this kind of money over 25 years. Your starting amount could be still 1,000, 25 years, return of 20%, going for more maybe aggressive stocks that we cover on this channel. Compounded annually again with your additional contributions of every month of £225, you will be roughly around 1.5 million after 25 years. You can see how it all starts to add up very, very quickly. First 10 years, your money doesn't really do a lot. And then the interest really kicks in. And it's just like your pension. Those last load of years is crucial. I don't know what date you're watching this video, but currently we're offering a discount on the trading course until the end of the month. Then it's going up and that price will no longer be there. We have yet to have any bad feedback, so we're now offering money back guarantees. If you think that this is something that you're interested in, definitely check out the link below. And I would watch this video, my top 5 tips on how to save some money. Please smash that subscribe button and I'll catch you then. Peace.